we've got those PMI reads, and we've also got, of course, an economy opening up. And tell me something. You remain, though, rather cautiously optimistic on Asian credit overall. And I just want to get a sense of why, and you're not totally in there, and where we go from here, if you will.
Sure. So we did enter the year actually with an optimism, but we have seen a fair bit of returns in just the first month. So the credit has returned 3% overall, and close to 7% for the high yield market in Asia. So you've seen obviously some front loading of returns. But one shift which has happened in my mind very clearly, given where the overall carry and income is in the fixed income markets and in credit markets, and the tailwind from China reopening, as well as the shift in the policy side, there's a fundamental move in the investment strategy where I would say you should be buying any of the corrections in Asian credit from here rather than selling the rallies. So we still remain optimistic, but given obviously the squeeze we have seen in the first 4 weeks, I'm going a little bit on the sidelines tactically, looking for entry points in the coming months.
Where do you suspect, Neeraj, those entry points might be? Because you did mention it's 3% on credit, 7% on high yield. I mean, that's quite substantial for a month.
That is. On the investment grade side, obviously, it's a combination of the rally in the U.S. Treasuries as well as the spread return, whereas in high yield, it's more driven by the policy shift in China, and specifically the China real estate policy. The China real estate high yield sector, in fact, returned 15% year to date, which is in the last 4 weeks. So I would say from the treasury markets perspective, as we go through the Fed cycle and to some extent the messaging from the Fed and the other central banks, I do expect to see a little bit of volatility in the market still staying, giving those entry points from the standpoint of adding more in the credit in the portfolios.
I mean, we look at Chinese high-yield dollar bonds on a record winning streak now, Neeraj. You know, what do you think this is really all about? Because, of course, part of the reason is the developer side of things, and the junk market there rocketing from a record low 49.3 cents on the dollar to 78.7 cents as of Friday. Now, that's the highest in a year. Are people now thinking that this property and developers crisis is over with?
I think the worst is behind us, but we do need to be mindful of the fact that you need to start seeing the shift in the fundamental data. And what I mean by that is you do need to start seeing the housing sales picking up. We'll get the data for January soon, but that trend has to be positive for this rally to actually sustain. The liquidity side to some extent has been resolved specifically for the larger players, and I would say you want to stick with quality.
So when you talk quality, maybe let's elaborate a little bit more on that. So we're talking, without going into specific names, for example, say the platform companies, which are still yielding you, I believe, 4 or 5%. Do you think there's value there as far as that's concerned? In the dollar bond market, of course.
Sure. Well, quality is a fuzzy blanket, so it's important to look under that to really define what it is. And I think it depends on which part of the market you're looking at. In the front end of the curve, we are very positive on credit across the board, specifically on the investment grade space. We do like, obviously, in IG, the Korea, where the spreads are not very wide, but it gives you the safe quality carry. And in high yield, what I mean by quality, it comes down to the fundamentals, the idiosyncratic risk. But if you think from a rating perspective, the higher part of the quality curve in the high yield, more in the double B space than down the credit curve.